everyone to Risk Management for Public Entities, so RMPE 352. This is the first session that we'll be hosting tonight. And again, each of these sessions to give background for those that have not participated in the ARM study group webinars. But typically we're going to do 10 sessions. Actually for RMP 352, we'll have to do 11. Unfortunately, the chapters are quite long, and I couldn't combine any of the chapters to try to shorten that up. Typically, each of the classes is about 90 minutes long, and so approximately this is about 17 hours worth of course sessions that you're going to get over the next 11 weeks. So one of the things I would like to do at the very beginning is to thank the Public Entity Risk Institute for sponsoring this event. Typically, on the sponsors, when we've done these in the past, individual organizations may fund this some for their employees, but PERI, along with Prima, who is the administrator now for PERI, went to the board and was able to get this approved. So unlike the other courses that would be necessarily hidden behind more lockdown for security and those type of things where people have to log in, this course will be publicly made available to any and all that would like to take it online, as well as whether Prima or PERI may end up putting some of the course sessions on their website as well. That may be happening too. The course schedule, I did mail this out, email to all the participants earlier, but as you can see, we do have, this is probably what, over the next 13 to 14 weeks here. Tonight's the first class. We'll do a quick introduction of what the course is going to be about and cover Chapter 1. And then each of the following weeks, we will cover one chapter at a time. When you'll notice there's a couple breaks there. On September 4th and 11th, we'll have a 2-week break where there'll be no classes, and again on October 9th. Now, there's a possibility that we may have to modify the schedule, partly due to either my travel, where you might see that, but we will try to complete this as best as we can to do the course review by October 30th. As many always ask about recordings, every session is recorded, and along with that recording, the slide deck will be made available on the website. So you'll certainly have access to that, and you'll do that by going to armstudygroup.com, and you'll click on the RMPE 352 tab, and again, you won't have to log in. It'll be publicly available for everyone to view. Typically, the recordings are posted within probably 24 hours of the class ending, and in many cases, probably within a couple hours of the class ending. I try to get those up as soon as possible, especially for those on the East Coast that may be taking the course, so that they can review the course material as soon as possible. Now, for scheduling the exam, you'll see that depending if you have an approved testing center on your own site, the cost is relatively low. But if you have to do ProMedics Testing Center, the normal fee is $140, and late registration would be $205. This is the testing window for this quarter. You can test at any time. They just do windows mainly for being able to charge the different amounts. But this window basically will end December 15th. So you have basically now, if you're going to do the testing window, October, November, December is the testing window that you'd want to select, but you can always choose one after the first of the year. The exam itself is 75 multiple choice questions, and you have 2 hours to complete it. Unlike the other ARM exams, this is a paper-based exam still, but it is multiple choice. They may have changed whether it's computer-based, but my understanding it is still paper-based. Now, if you look at that pass ratio, unfortunately, this is the lowest pass ratio of any of the courses, and this is within the last quarter. What they do is a rolling average, and so less than half the people that do take the exam pass. Hopefully, with this course, you'll be able to get that number up. I think part of the challenge is why that is so low is most people can only self-study. There has not been an online course like we're doing now, and so hopefully this will certainly provide better information and get that pass ratio much, much higher. So for those that haven't done the online course before, this may be a little new, or haven't taken an ARM course in a while, we'll cover a couple tips for that. So don't waste, as far as the slides, we provided those. You can certainly take notes there. Questions are important, but we have only approximately 90 minutes to cover all the material for each of the chapter. Our goal was 10 weeks when I originally put this, but now we're looking at 11 weeks. We're going to cover one chapter per meeting. And really the primary purpose of this is for everyone to pass the national exam. We will be hopefully I'll be making the information to life for you, for providing some examples and anecdotes that will help you better understand the material, and then also bring the material really into context. That's part of what my plan is as well. But at the end of the day, I haven't done my job if you're not passing the national exam, and so I'll give you some tips and some areas that you'll want to focus on as part of that. What we'll do is you'll see in each of the beginning of the course, we will review the educational objectives. And I encourage you, that's the first thing you should be looking at, because the educational objectives is what the tests are based upon, of what they're trying to teach. And so you want to look at what those objectives are first to make sure you understand those. Terms and phrases typically are going to be important, so whatever is bolded, in which they provide the definition for, you want to make sure that you do know those terms and phrases. There will be typically some type of questions on the exams with those. As well as some of the text exhibits. They're not going to test on the exhibits of the examples of the wording in there, but it's going to be the concepts that they discuss in there. So it's important that you just don't skip over the exhibits when you see those. And then finally, the chapter summary at the end is important as well. Whatever's repeated at the end of the chapter, based upon the course objectives, is usually going to be, that's important enough that's being repeated. It's most likely going to be some type of concept that will be tested on the exam. People always ask about the course guide and the review questions and some of those things. I typically don't recommend, or you don't need to have the course guide. For some, it's a benefit. It gives a little more structure. But usually, just by reading the book and using the webinars, that should hopefully be enough for you. But it really depends on your learning style. Unfortunately, with this class, typically they have an instructor's course book that they didn't provide with this, where I can usually kind of provide some worksheets and other homework, but unfortunately there's not a one available for RMPE 352. When you go through, as I mentioned before, you want to have an answer for all educational objectives. You want to make sure you understand those, and again, review the exhibits. You want to make sure you use the same terms and phrases that are used in the book. Now, as times have changed, sometimes you may have your own lingo or wording that you may have, but if the example talks about 4 pre-law schools and 6 post-law schools, well, you have the same ones. So again, this course requires memorizing content in some cases, but not creating new examples. And what I always tell people is you want to think about information at the 50,000-foot level. What is the general concept? Because usually if you, on the exam, if you understand the big picture concepts, you'll be able to decipher the questions and be able to answer some of those without even maybe remembering that specific example, because it's about the big picture. They're not necessarily going to get too much into the weeds on the exam. Use acronyms to keep lists separate, and I'll show some examples there. And also, the idea that test questions frequently interchange information. So what I mean by that is that throughout, when you take the exam, you're going to find maybe a question that you may not know the answer to, that's in the first part of the exam. Later on, they might provide some information that gives clues to that question. And so, and this is more from the exam standpoint, that as you kind of see that information, you want to make sure that that everything kind of works together. Each chapter is going to stand on its own from an exam standpoint, but they'll usually provide clues that will help you out as you go along. So with that, we'll go right into, if there's any questions, I'll certainly answer those now before we get started. But as we go through, the last course session in the final week will be a course review, and at that time I'll be spending more time on what to expect for the exam and how to prepare. For those that haven't taken an exam in a while, that usually is beneficial. And then also we'll go over the key highlights of each of the different chapters of those things that you should probably study just a little bit more. So if there's no questions, if not, we'll answer them at the end, or you can email me individually as well. So going into Chapter 1, the foundational chapter here. So what's so special about public entity risk management? Why have a course specifically on it? And actually, that's one of the things that for a long time I wouldn't necessarily focus too much on doing the public entity. Because risk management itself is for the most part the same there. So so as we go through here, just like I said in the very beginning, we are going to cover, first of all, the educational objectives. So, and I'll put these on each of the slide decks. Unfortunately, this one goes over to 2 pages here. So the educational objectives for Chapter 1 describe how fundamental differences between public administration of government entities and general business management of private entities affect risk management activities in the public and the private sectors of the economy. And that's that big picture piece of it. Identify and describe how public entities should perform each of the steps in the risk management decision process. And we'll go over a little saying of I am extremely savvy in money, which will help you memorize that 5-step process. Objective 3, identify and explain the significance of contrast between public sector risk management and private sector risk management with respect to organizational objectives, the structure, financial management, manager accountability, as well as the political environment. And what you're going to see on the right-hand side is basically the outline of the course as well. The 4th objective, describe and illustrate the distinctive exposures of public entities to accidental loss. And finally, define or describe each of the keywords and phrases for the chapter. And again, that's why the keywords and phrases are important. There'll be most likely questions on that. So, so those are the objectives that we're going to focus on. And if you look at the distinctive exposures that it talks about, the exposures that we will be talking about in that section are going to be property, employment-related, roads and streets, and so you want to understand what are those exposures and how are they different and from that perspective. So going a little bit deeper, so what's special about public entity risk management? Well, the differences, there's really 8 key differences that they identify in the text here, and we'll go a little more detail in each one of these, but you'll probably, just from the very beginning, have a question that deals essentially with this question. And they'll probably list most of these and they'd say all these except for are differences or some of the special areas within there. So the first one, essential government functions, scope of exposures, special legal requirements, public interest and nonprofit objectives. Obviously the power to tax, is something different that public entities have. The public scrutiny, obviously, for those that have public board meetings know all about that, as well as tax status and different accounting procedures. So let's dig a little bit deeper into each one of those sections as we go through here. And for those that are also following along the textbook, this is basically what we'll be covering is essentially really on page 2, 3, and 4 are the first couple chapters here. So one of the essential government functions that makes public entities different is that there are certain things that a public entity has to provide. If you're a K-12 school district, you have to provide education, no matter the type of student. You don't turn anyone away, whether they're special needs, things like that. So that means that unlike a private sector school or a private school that can decide who they want to take, they may not be able to do that. So, or they can reduce their costs. And so I served on a school board for almost 20 years, and that was always one of the things is that public education and public schools have to teach those that are often the most difficult to teach, and even the discipline issues where the private schools can pick the best and the brightest in some cases, and don't have the expense of teaching a special needs child, which in some cases can be $40,000 to $50,000 a year just for that individual child. As well as from a municipal standpoint or county or even a university perspective, a lot of times providing police, fire, water, or it might be essential public services that the public entity needs to provide. And of course, the private sector can decide whether they want to go in those type of functions or not. The scope of exposure. Well, and one is going to be a little different. And one of the things that I try to point out is that whether you're a city or a town that has a population of 200, or your large LA, the city of LA or a county, you're still going to have the same exposures. They may not be as large from a risk standpoint, but you still have to deal with the same type of insurance requirements in some cases. So small public entities can have more risk than a large corporation just because they maybe have to contract out police and fire, or they have to provide those essential services. And so they still have the risk regardless of the size. It's just the amount of that risk may be different. And so what happens is they still have to develop programs and risk management programs and policies to address those various risks. The special legal requirements that we often see, there are some on one side who might be exempt from laws, so we have some advantages there. But at the same time, there's often restrictions on actions that a public entity can take. In California, we have the Brown Act, which is an open public meeting law, and almost all public entities have to have open meeting laws which they have to deal with, which means that dealing with certain types of issues, everything is documented. That means Freedom of Information Act requests can be part of that. And so the decisions, when you look at some of those special legal requirements and the documentation requirements, certainly makes public entities a little bit different. And that's probably why we see things move much, much slower in public entities, is partly because of that open meetings and because of the potential scrutiny that might take on. Public interest and nonprofit objectives. So as a public entity, it's more for the social good aspect rather than the profit motive. And the challenge that as a public entity we have is providing those services within budget constraints. We only get a certain amount of money, and we have to try to provide those services within that allotted budget. And it's not a thing where we can just raise prices and things like that. In many cases, we're trying to reduce our costs, and we're eliminating staff to provide sometimes some of those other essential services as part of that. We already talked a little bit about this, but the power to tax. We can only generate revenue through taxes and fees, essentially. Or we can raise revenue through a bond structure, possibly. But again, those are more loans, and even those many times will have to be approved by the general public. The political scrutiny. Elected officials have agendas which can make long-term planning difficult. So on the political scrutiny, there's a couple things that they talk about in the textbook. One is the agenda aspect, that someone gets elected and all of a sudden the priorities change within the organization. And so trying to meet those objectives might be, from the political pressures. And then again, the political scrutiny of the public, of the various watchdog groups, or some people that maybe have their own agenda and will basically be at the board meeting all the time and stepping up to speak up on some of those issues. We talked about the special tax status a little bit. Public entities are typically exempt from income and sales tax, so that is one benefit that they do have. But then on the flip side, differing accounting and budgeting procedures. Public entities have fairly specific accounting rules through GASB, General Accounting Standards, as well as conservative investing, whereas a private sector company can invest in some types of maybe more stocks and other types of investments that generate more income. Public entities, just because of the nature, are usually restricted in the type of investments that they can enter into as part of their revenue portfolio. So one of the things that they kind of go into, but this is really kind of the essential part of the risk management process. And for those that took the old ARM series, this will be familiar, which is the 5-step risk management process. And what I try to encourage you to do is just remember the wording, I am extremely savvy in money. So the first one, I, and the first kind of bullet is two of them, but identify and analyze loss exposures is really the first step. And these are steps that are supposed to be taken in order, and I think that's important to note as well from the exam. Most likely you will have a question on the 5-step process. So one thing I forgot to mention at the beginning, anything that's typically in a list or in bullet points in the text is something you're usually almost always going to want to memorize, especially if there's something that's in order. Those are typical questions that you'll see on the exam. So something like this, you definitely want to make sure you have that memorized, that I'm extremely savvy in money. So again, the first step, identify and analyze loss exposures. And we'll go through these steps as well in more detail. Examine risk management alternatives. Then you select that among the risk management alternatives, select one of those or two, implement the chosen risk management technique, and finally you monitor and improve the risk management program. And even though this sounds fairly basic, this is probably the process that I've used most of the time when I've come on board to a new organization. Is first step, you identify and analyze the loss exposures, and looking at loss runs, the information, the organizational charts, what are the exposures that the organization has. Look at some of the different alternatives, and we might be able to manage those, whether it be loss control techniques, maybe we transfer the risk, and then we select which one. In many cases, it's going to be a hybrid. We're going to do both risk management and buy insurance and do some transfers. So we're going to select those, and then you finally implement, and then you monitor the results as part of that. So a little more detail that it goes into, and again, for those that are looking to follow along, this would actually be on page 4 of the textbook, is a little more detail about the various steps here. So the first one, identifying and analyzing loss exposure. So, and this is where it's special about, again, public entities. So the difference is that public entities face are likely to differ from private entity because of the different activities and legal environment and organizational objectives. So if you think about, again, I use cities and counties typically, and even universities as an example, just because they have all the almost every exposure you can think of. They might be running an airport, which is unique. Private entities don't typically do that. Police, fire, parks and rec, swimming pools. There's exposures there. Daycare centers or early Head Start might be some of the different exposures that are a little more unique. So identifying and analyzing what those various exposures are, road design, the list goes on, and we'll go through those various exposures at the end of the text here as well. The next step is examining risk management alternatives. And even there, typically a private sector company, and what's important here is that the techniques that a private sector company has are probably a little bit more than a public sector. And partly because of the legal environment, in some cases the political environment, to do certain things. So, forming captive insurance companies, private sector companies are forming those all over the place. And actually, it's not, public entities typically don't. Having worked for the University of California, they recently formed what's called Fiat Lux, which is an insurance captive for the university. And so it's, while it's not common, it can be done, and it's usually your much larger public entities that can do something like that to form a captive. But again, your techniques that you may have at your disposal may be somewhat limited. And if you're a smaller entity, maybe the alternatives are more from a risk pooling or joint powers authority might be some of the alternatives that you have. And what typically happens with public entities, I would say now, is that buying commercial insurance is probably most likely not one of the alternatives unless you have a really high deductible or self-insured retention level, just because usually commercial insurance, they price public entities out of the market, which really, from a historical perspective, why did risk pools get started? It was in the early 80s, essentially, where the commercial market was going crazy, and the premiums were increasing doubling each year, and to where really public entities could not afford to buy insurance. And so if you do some a search on that information, I think about 1984 is where legislatures started giving authority for the creation of public entities, and also which led to the creation of PERI in the first place. That was led because of how the insurance companies were not providing information, and it was a lawsuit of all the attorneys generals from the various states, which basically formed PERI and funded PERI for a long period of time there. The third one, selecting among the risk management techniques. The challenge there is you might have some different techniques, but how you can, selecting those might be influenced again by public interest goals. There might be constitutional requirements or charter provisions within a city charter, some budgeting processes, tax law, insurance market conditions, a hard market versus a soft market, may affect maybe a self-insured retention level in some cases, or the ability to implement risk reduction techniques, so being able to hire staff if the budget's tight. A lot of times safety is one of the first things that ends up going, unfortunately. And then also the political considerations that most private sector companies don't have to deal with. Once you implement the chosen technique, while while it'd probably be somewhat similar, a lot of times maybe the techniques or the procedural requirements might be a little different from public to private. Not a lot of detail from in the text about that, but that might be part of it. And then finally, monitoring and improving the risk management program, the standards and procedures by which a public entity monitors and evaluates the performance of its risk management program will differ from private sector because most public entities have high priority specific organizational objectives and measures of performance that may be of a lesser importance or irrelevant to the private sector. So essentially, just because, and that kind of goes back to the documentation aspect, that the monitoring and focusing on certain elements because of audits that may be performed and those type of things, that there's going to be more attention paid into certain respects that for private sector companies may be considered to be trivial, basically. And I put this last, kind of sentence here because or the paragraph, because I really felt that this encapsulates really the difference here when you really look at public entity versus, what's different about public entities. And I will just read this slide since I know some people listen to this on airplanes and Google or on iPods as well. So effective risk management generates many benefits for a public entity, the community it serves, the economy as a whole. For the entity, risk management can reduce the cost of risk and the negative effects of losses. And then for the entire economy, it helps prevent waste of resources and directs resources towards more productive activities. Public entities are sometimes indistinguishable from the communities they serve, and any loss for the entity is a loss for the community and its citizens. Therefore, risk management programs that benefit the entity also benefit the community and the general public. Now, why I make sure I read that and put that in there is if you look at one of the objectives that we have for the course, and being the first one, I like to highlight these, is that's actually one of the objectives that we want to do is how basically, the first one benefits society and how risk management activities in the public and private sectors, how it benefits the economy. So that's one of the very first objectives, and that's, I think, a good synopsis of really that first objective is to understand, and again, that at that conceptual level is to understand that that's really what we're doing by saving taxpayers money, by having effective risk management programs. Essentially, we are benefiting the community and we're benefiting the economy by not having those losses in the first place, which allows those dollars to be redirected, hopefully, towards programs that will even benefit the community even more. So steps in the risk management process. So we're going to go through those specific steps on there. And again, this is one of the main objectives for this chapter. So the first one is identifying and analyzing loss exposure. So, well, how do we do that within the public sector? What are we really looking for? And so one of the most common, the first things we'll look at is the types of values that are exposed to loss. And so what are some of the things of value that are exposed to loss? Well, first of all, property. So our buildings, tangible property, land, building, in this case also equipment. So vehicles would also be considered part of the property that we need to look at. So when we go through, and if you're brand new to a city or you're brand new to a public entity, the first step is you want to start looking at, okay, what are the properties that you have that are exposed to potential loss? Again, those tangible. Then also, you got to think about the intangible property. And this really goes to, police and those is that what about, rights or privileges or reputation? That's kind of, one of those things that maybe people don't think about too much, but that also has to be part of the discussion. It's intangible property on there. Another value could be freedom from liability. So so one of the losses when it kind of talks about this, and this is, I don't think is the most clearest language when we look, but I just say liability in general as a loss. But when you cause harm to a person or a violation of a citizen's rights. So if they trip and fall on a sidewalk because it's uplifted, a student gets hurt in a sporting event, or there's a bus accident, or for universities, where whatever on a campus, being a large campus, the student gets injured on the campus. So anything causing harm to a person is part, and again, violation of a person's rights can also be, whether that in some cases for most cities or public entities, that usually has to do with ADA, can be as a violation of their rights, or not being hired, could be like an employer practices liability claim. So again, from a, I don't necessarily like the word freedom from liability, but that's what they use in the textbook as one of the values exposed to loss. Net income. So a loss, when we talk about net income, we're talking about a loss that can be due either to a reduction in income or an increase in expenses. So essentially, for public entities, every time we have a claim that results in a loss of money, that is a net income loss to the organization. And then lastly, key personnel. So typically when we think of loss of key personnel, that's going to be either through workers' comp or an injury to where someone, or even someone retiring or leaving the organization that's key to the organization, and they can be leaving because of benefit reasons or other things. So when we think of these types of things holistically, benefits and all those things are just as important to keeping key personnel, just as much as preventing injuries from occurring. And so key personnel are, again, those with a person with special knowledge or skill that can certainly, if they got hit by the bus, that's kind of what we're talking about when we talk about key personnel. Next area that we would look at is also what about peril. So we talked about what could we have a loss at, what things could, the values or those things, things, and then we have what are the perils. So what are the things that could actually cause a loss? And so in this case, there's 3 different types of perils, and again, this is one of those where you say, okay, what's a peril? Well, it's a natural peril, or a human peril, or an economic peril. So these things typically are accidents or catastrophic events. The results, and it often can be grouped into the original causes. So this is where we want to group things. So an earthquake, flood, or in California, wildfires, of course, are a natural peril. I would even say, in this case, droughts in California would be considered a natural peril of how that is affecting local communities, especially water districts or some towns where they have to have water brought in. And then how do you fight fires if there's no water? So some of these types of things, I would say, certainly would be considered a natural peril as well. The human perils are those that are due to action or inaction of a person. So something, someone getting in a fight, those things that involve, again, an individual. And then finally, some of the economic perils. They can be acts of government or large numbers of individuals, such, in this case, examples they gave in the text. A boycott, a war certainly can have economic impacts when you think about prices of fuel and how that may impact a public entity or a transit district, especially. So I know we have some transit companies, transit districts that are part of the class tonight as well. And then lastly, changes in technology, the way we kind of do business, how we store our material. The idea that everything used to be paper-based and now it's all on the web. How does that, from an economic standpoint, either benefit or hurt the public entity? And then lastly, the consequences of loss. So we know, so if you kind of take this in progression, we say, okay, what can happen to a building? Well, it can have a natural peril, a wildfire catches on fire. Well, what's the consequences of that? So some of the consequences that we might see from those is continuity of operations. So as a public entity risk manager, we want to look at, if a building burned down, how would we continue to do business? Can we continue to do business? So that's got to be one of the areas. Stable revenues and expenses. If we have our area because of drought, let's say, where people can no longer live there, and then people move out, we lose our tax base. So that can also have a consequence. So you hopefully you're seeing the progression here of how public entities, how we would look at these things, probably a little different than a private sector, whereas, they build a store, they do certain things. In the public sector, if we're a town, we're a school, the revenue that's generated from ADA, from kids attending the school, all these things can certainly have an impact. Actually, the example I like to give, and from my school district, one of the perils that I'm always concerned about is lice. The impact, because in California, it is ADA. We take attendance every single day, and if a child's not there, you lose the revenue for that day. Well, we had at one of our schools an outbreak, a lice outbreak in 2 classrooms, and essentially for almost a month, we lost one kid or several kids had it, the teachers had it, we had substitutes, all those things from something because if you think about the cleaning procedures afterwards, what are our policies on letting kids back into the school before, making sure that they're completely checked out? All those types of things essentially had a revenue impact. So here you had, if you'd say, okay, if we kind of go back and say the type of loss, in this case would probably be both a net income, would be mainly net income, and also I would say key personnel loss that we had. So if we kind of categorize a livestock break, well, is it a human peril, economic peril? Well, in this cases, if it, I would say it's somewhat human due to action or inaction of the, of not taking care of the situation. You could say, well, lice is natural, or I would say it's not a natural peril in that case. But the impact, obviously, is that it certainly affects the revenue of the school district, and also the education of the children as well. Humanitarian concerns would also be one, so that's where you get into, potentially if you have disaster recovery, those type of plans, so making sure you meet those. And then lastly, some of the legal requirements that you may not be able to meet because of some of those type of losses as well. So how do we go about, and if we identify, we have property, all these things. So how do we know what to look for, and to say, this is a big exposure, it's a low exposure to the organization. This is another good, because it's bullet points, a question that you're probably going to see on the exam is, these are the typical methods that you're going to use to analyze loss exposure. So surveys and questionnaires. A lot of times that's where you'd have more insurance companies would do some of that. But you can certainly, through a survey or questionnaire, of even asking the departments, what are the biggest things? Where are the losses? Where do you see those type of things? What are they concerned about if they were to have a major loss? And so that's where the surveys and questionnaires, and actually just the in-person interviews can certainly come into play. The loss histories. So depending on the type of losses that we're looking at and how long the organization's been around, typically you're going to have loss histories that you can look back on and see the types of claims that the organization is experiencing. Now that works pretty well for workers' comp type of exposures, but when it comes to general liability, it's a little more difficult because your losses aren't occurring as often. And so at that point, that's where you kind of look at what's some of the political climate, or what are some of the key things that are going on from there. Financial statements can also help, because usually the financial statements will tell you where money's being budgeted, where are the biggest risks. If we're spending a lot of money in a certain area because of a big project, obviously that's something, a new community center where we're building. That financial information from the budget process should be able to tell us, okay, that's something we want to make sure that we properly insure. So that gives us an idea of a potential risk exposure, or at least a property exposure. Or if we identify either how many new vehicles we're purchasing, or buses if we're in transit, it'll give us a pretty good idea. Other general records and documents, and as it indicates, just any other type of document. Flow charts. Where are bottlenecks in a process? How do we, if we identify maybe it's a net income loss, how does money go from the community center finally to the bank? How does it get transferred? Might seem trivial, but if people know that the money from the swimming pool, the person basically just takes it on their own to the bank, or they drop it off and it goes to different places, that through a flow chart or looking at that process, you'll be able to identify where there's potential exposures for either theft in the process, or even whether the person steals it themselves or others. As well as personal inspections, and actually that's probably my favorite one, is actually going out and seeing the sites, understanding the types of risks that employees are taking on. Actually, one of the general managers for one of the Parsac, which is a pool out in California, the general manager actually went out on snowplows and got tased and did some of those things because she wanted to actually see what the employees had to deal with, and so that, and as a risk pool, she wanted to understand the risks that the pool was trying to ensure and protect. And so doing those personal inspections really as a risk manager is key, and I think too often risk managers are kind of locked up in the office dealing with claims rather than kind of seeing where the potential exposures are to try to prevent them. And then lastly, consultation with experts, and that can be any type of consultant that comes out, or in many cases a broker. I'm sure they have a better idea of the types of risks that the organization might have to deal with. So once we identify and we analyze, so we did the first step, identify and analyze. So we did IN. Now we're doing extremely, which is examine the feasibility of alternative risk management techniques. And so for most of those that have been in risk management, these should be hopefully fairly obvious, but you really there's two main techniques, which is risk control and risk financing. But under each one, there's a little more detail under that. So when we talk about risk control, one of the first things you can do is avoid the risk, period. Avoid the exposure, not do it. So what kind of exposure would you want to avoid? From a maintenance standpoint, do we want people, up on high rises washing windows? Do we want to get into, let's say, a community service district decides that they don't want to run the municipal, pool anymore, and they say they'll donate it to the city or county. Well, that means the city or county has that exposure, and does the organization really want to take that on? So you can avoid it just by not doing it in some cases. Again, for public entities, that's more of a challenge because there are certain things that have to be done anyways. So if you still have to do it, the next one is loss prevention. When we talk about loss prevention, we're really talking about reducing frequency of the type of claim, and then we can also do loss reduction, which would reduce the severity. My experience on the exams from the past is typically there's a question that deals it gives a definition and talks about which one of these reduces frequency and which one does severity. And so you want to make sure you do understand the difference between loss reduction, which reduces severity, and loss prevention, which reduces frequency. Now, to give an example of that, to give you an idea, is that let's say you have a fire sprinkler system. So is that a loss prevention or loss reduction type of activity? Well, it doesn't necessarily prevent the fire. So in this case, it doesn't reduce the frequency of the fire. It just prevents the fire from spreading. So in this case, sprinkler systems would be considered a loss reduction technique. So the event still occurred, the fire exposure still occurred. So you still have a frequency hit, but at least the damage that the fire caused would minimize. Unfortunately, you're most likely going to have a lot more damage from the sprinkler head in some cases because of the activation. Now, an example of something that we've reduced frequency from having in the first place. Well, let's say you, so my favorite is Shoes for Crews, which is a slip-resistant shoe for food service employees. So for universities, when I worked for University of California, we had a huge amount of slip and falls in our food service. And by buying just a simple pair of a $30 pair of shoes twice a year for our employees, those slip and falls were reduced about 70%. And so in that case, we reduced the frequency of those claims because we didn't have the slip and falls that occurred in the first place. And actually, by default, you also reduce the severity because now, no claim is the best claim of all. So, by not having the frequency, you automatically reduce the severity as well. You can also have the other technique is segregation of loss exposure units. And this would be the case if you're a public entity for spreading buildings further apart. When we talk about, or if you have a bus fleet, let's say for transit, instead of having everything in one location. So segregation basically means that if there was a fire or something occurred and it destroyed all those vehicles, let's say in this case from a yard, a fleet yard, that you still have another location that's available. Now, segregation is typically an expensive proposition because now you have to maintain two sites. But depending on the risks as you look at your identify and analyze, this is one of the things you want to evaluate as a potential. Does segregation make sense for the organization? And then finally, you can contractually transfer for risk control, which means you basically have someone else do the work, and so now that risk is transferred to that other organization to basically do that. And in ways, that's kind of somewhat tied to exposure avoidance, since you're not necessarily performing it. That's if you don't do it at all, versus in this case, transferring out the activity itself to a third party. On the risk financing side, really there's just two main techniques, which is retention, meaning you're going to self-insure, you're going to retain that risk. Hopefully you do it on purpose when you retain the risk. And then the other way is contractual transfer of risk financing. So contractual transfer is another way of saying buying insurance is certainly one way, which essentially insurance is a contract between the transferor and the transferee of that risk. And so you pay someone else, in this case an insurance company, to take on that risk. Or if you're part of a risk pool, that's the same idea, that you're essentially paying, you have a contract or an MOU in place with the risk pool that essentially says, you know, we're going to pay this amount of money. What's different about a risk pool, obviously, is I think most people that are part of one know that it's more of it's a co-op, that pretty much everyone owns the risk and everyone agrees that they're going to share that risk as part of that. The other way that we can transfer risk or for risk financing is through hold harmless and indemnity agreements. And so, so anyone that has any type of activities, bounce houses or swimming pools or other types of community service district, which they do training, most likely there's a hold harmless and indemnity agreement that's in place. And basically almost every contract that the city and county will be having, and university or any other public entity, will have language that basically hold harmless you know, the organization from any potential future lawsuits because of damage, and basically to agree to indemnify the public entity for any of those claims. And then next step is you're going to select the most appropriate technique. So we've evaluated the different techniques, you know, which ones make the most sense, and then at some point we're going to select that technique, and we have to determine, you know, the combination of risk control and risk financing techniques that'll be most effective in controlling the organization's risk exposure. And the reality is that almost every organization, whether it be public or private, is going to do a mixture. It's going to be a hybrid. No one ever just does risk control, typically. There's going to be some retention involved, and then there's probably some insurance involved to a certain extent in each one of these activities. And hopefully, well, I would say public entities where they probably do that, at least from my experience, is they just count on the transfer technique, on the insurance, and they may not do the risk control as much as they really should, or the loss control. And actually in the study that we recently done, that's one of the things we're finding is most of the public entities really need to focus more on loss control as part of their programs. And as the text in this, I took this from the text, and I think this is, you know, again, conceptually the 50,000-foot level point that you want to get across. In deciding on the most appropriate risk management alternatives, public officials must consider the objectives of the public entity and factors such as the political climate, the entity's tolerance for risk, obligation to provide service regardless of associated risks, legal limitations that may restrict the entity from using particular risk control and financing technique methods, and as well as budgetary concerns that may not follow sufficient funding of the chosen methods. And I guess this is my other pet peeve when it comes to public entities, is that public entities usually do a pay-as-you-go system, which becomes a challenge if there is a large loss in the current budget year. And so actually reserving requirements and how they reserve for those dollars to set aside that money really in an escrow account to make sure they have money to pay for the claims. And again, for smaller entities that becomes a challenge, but this is part of the selecting the most appropriate technique. And some of the limitations and the pressures is that most public entities don't necessarily have the dollars just to set aside in escrow for future liability. But I think many organizations have seen, like with pensions, that's been the main issue with the whole pension reform, is that most public entities were doing pay-as-you-go, and it wasn't a liability on the books. And so that's why we're seeing such a large discussion on this issue, is because of this. And it really is a risk management issue, pensions, all those types of things, because it, you know, it may not be in the department, but technically it's protecting the assets of the organization. And then once you implement the selected technique, the main thing you're going to have there, and it talks about in the textbook, is where they describe it as technical versus managerial decisions, which technical decisions are within the authority of the risk manager, and may need to have to explain some of those. And the technical are those that probably don't require the risk manager to do the implementation. But the managerial ones are, those are the ones with the line authority. So when you want to say you want to implement a risk control program, you're going to have to count on that line manager to implement those types of programs. Whereas, again, technical, if you're buying insurance and those types of things, that can be done fairly easily, and it's more of explaining. So those are the kind of the two things that they mention on the textbook regarding implementing. And then lastly, the last step in the risk management process is monitoring the risk management programs. And they kind of mention in here, that given how do you measure success and going through the program here. The main elements are program should be measured using two methods: result standards based upon quantifiable outcomes that the program strives to reach, and activity standards that focus on steps taken to manage risks. And the reason why I think in monitoring, why it's important, why they kind of the overarching, that there's most likely a question on this, why are those important? And why aren't you just measuring on the amount of losses? Well, for general liability and other types of claims, many times you're not going to have, you may not have losses or a very limited amount of losses depending on the size of the organization. And to measure results year after year when you may not have those losses, it might be partly due to because of the risk control and the other programs that you have in place. So that's why it's really important that when you look at some of the programs, it's having both activity and result standards. You got to have a mixture of both to measure the programs, and so that's the key point to get across, at least on this section of monitoring, is to have how you can be able to say whether you're doing a good job or not within those. So going to the next section that we start talking about is public and private sector risk management contrasts. So how are we, this is again, how are we different? And the key thing here is that the risk management process, and I highlight, is essentially the same for public and private sector organizations. The steps that we're going to take, and again, I am extremely savvy in my, identify and analyze, evaluate, select, implement, and monitor. That process is the same, whether you're private sector or public sector. The challenge that you have is the exposures that you're looking at are different, and how you can implement and what you can select are different. And so I just want to stress that as the key point. For those that have worked in both public and private, you'll recognize this. But for those that haven't, have worked in primarily in public sector, the process is the same. And that's where I guess when I look at why we have an RMP or RMPE 5352 program, it's really understanding how you can analyze those things differently or look at those loss exposures that are different. But we're not really talking about where the process is different. So again, the difference is how organizations are structured and the goals and objectives. So when we look at some of the differences that we would have for private versus public and the contrasting, money or profit versus public good. There is no profit motive for the public sector to do that. When we look at revenue generation, again, this kind of goes profit versus surplus. As a public sector organization, surplus is often seen as bad. That if you have money, do you roll it over? You try, public entity organizations always accuse, well, if you don't spend it, then you're not going to get it next year, type of thing. And so it doesn't encourage saving, to save up for those types of things. So having been on a board, I always encourage that we should be doing well. That we want our departments to save money for those bad budget years, or to save up for those larger types of projects over a period of time. And so, but that becomes an issue when you look at revenue generation being different. The flexibility versus organizational constraints. The structure of a public entity, how decisions need to be made, the hierarchy within a public entity often makes decision making longer and more difficult. Where there's a certain amount of the contrast when we look at the process, the goals and objectives of how we look at those things. Certainly, much more flexibility in a private sector organization. So if we look at specifically contrast and organizational objectives, what does that mean? So risk management decisions of the public interest depend on several factors that relate to the various areas here. So one of those is the political climate. Again, when you have an elected board, and depending on where you're at with that elected board, that political climate certainly does impact some of the decisions. And sometimes decisions may be made for the wrong reasons, or the board will make decisions if it has to go to the board for decisions. They make them more on political decisions, or whether it's more conservative area, those type of things of why decisions are being made. The tolerance for risk. So typically, public agencies are very risk averse. That they're not going to take on new risks, which a lot of times, even with some of the risks, there are hopefully some rewards that will come to the public benefit. But so typically, there's the tolerance of risk might be different. But at the same time, because of the types of services they're provided, and if that was the case, we would have police and fire because public entities would say it's too dangerous. But so at the same time, there's going to be a tolerance that we know we still have to do this. And so that's where you get into this contrast or the struggle within public entity risk management, the types of risks we know we have to do it. So then how can we mitigate those risks to reduce as much as possible? Which goes to the obligations to provide services. Again, police, fire, those types of things. There's also statutory requirements, or as many of us like to call them, unfunded mandates. I think everyone in the public sector is familiar with those, is that we continue to have more mandates placed upon us that we still have to continue those services. And so in some cases, we might have some minimum insurance requirements, or we might have to provide certain services that makes it more of a challenge. And then finally, some of the budgetary concerns. Obviously, of how we invest some of those dollars can certainly have an impact as a public risk manager. So this kind of goes more detail, again, with each one of those. The political climate, political wishes of elected officials, community leaders may influence risk management actions. Tolerance for risk, ability of its management and other personnel to continue functioning effectively despite significant uncertainties. And again, good public policy sometimes means assuming certain risks in the interest of the public, and that goes right back to the police and fire. Now, one thing that I should point out on the significant uncertainties, for those that are familiar with the ISO 31000 standard with the enterprise risk management, risk, kind of the new definition of risk, is really about uncertainties and your ability to manage for the uncertainties. The more certain you are of an event, then obviously that makes it easier. But when you don't, when things are in flux, you don't know the likelihood of an event occurring. That's where you get into the kind of the tolerance of how much risk are you willing to take on, or how much uncertainty are you willing to take on with the possibility of loss. And so that's really where that question's come from. Obligations, as I mentioned before, provide services, so the statutory requirements are part of that as well. So some of the subjective and objective risks on here, which I think that was looks like some of the slides on there got a little mixed up from where I saved here, so one moment here. All right. Obligations and the contrast. So obligations to provide service. We have mentioned some of these as being part of this. Obligation to police and fire. The other contrast, when we look at the organizational structure, government agencies exhibit some of the little different characteristics than we see typically from the private sector. One has to, when we look at the organizational structure, it's going to be the hierarchy. So when we look at the hierarchy, we have division of labor, span of control, and rules and regulations. And from a testing standpoint, you're going to want to know organizational structure. What are some of the characteristics? So again, anything in the list, you want to definitely make sure that you do memorize. A little more detail on each one of these. So hierarchy, as a risk manager, you must understand the position in the hierarchy and the level of authority that you have within there. And then often, because of the hierarchy, when you have a hierarchical structure, results in having numerous policies and procedures. And so, as we know from public entities, everyone has a huge big book of policy and procedures, or several binders full, and it's because of the hierarchical nature of the decision-making, of what's happened historically, those types of things that we typically see. We have a division of labor, and so government agencies are often create silos that make managing risk more difficult, meaning that because when you have, let's say a county, you have a public works, then you have maybe a fleet operation, you have those, and you have one risk manager. And so because everything's so divided, one of the challenges is how do you make sure you can manage all those risks? The risk manager needs to be involved in each one of those, and you really need champions for that. And if anything, that's why enterprise risk management is really taking on the hold more, is because the understanding that really everyone needs to manage risk, or needs to be a risk manager in that case. And so even those things that are siloed. So the division of labor makes that more challenging often, where as a risk manager in a private sector organization, you may not have any of those silos, and you can certainly work together. Now, private sector, I would say, just has many silos as public, but in some cases, but that is part of the challenge there. Span of control. Public sector managers often have a larger span of control, which limits supervision and increases risk. So when you think about how many managers or how many people that a public agency supervises, to a certain extent, that means you have more employees that may not follow the rules as much. Again, that makes it more of a challenge just because they're not being supervised, and again, that increases the risk just because the managers can't monitor what they're doing to ensure that they're following proper procedures in some of those cases, which goes right down to the rules and regulations. Also, we know public entities have our rules and regulations, but at the same time, we also know there's the unwritten rules that people follow as well. And so there's going to be some of the departmental norms and standard operating procedures that they've just done because that's the way we've always done it. And so even when the new regs or new policy procedures get written, in many cases, unfortunately, they're not followed. When we look at financial management, there's also some differences there that we certainly have. So sources of revenue, well, we kind of discussed that a little earlier, but revenue is more systemic. Taxes, bonds, and fees, which when I talk about systemic, meaning that when the economy is down or if housing prices, we've all seen this in almost no matter where you're at in the country, that certain things, property values went down, so we saw a loss of revenue from most of our cities and counties, which also affected school districts. If sales are down, if you're counting on sales taxes or revenue, that can have an impact. Or in California, another good example is largely dependent upon the stock market, Silicon Valley and new startups and people getting that. And so you had all the capital gains taxes were a major area of income for the state of California. Well, when the high-tech boom went bust, the state lost quite a bit of revenue as well. So you typically, because of the source of revenue being systemic, that's got to be a concern from a risk management standpoint. So it's not just about exposures from losses, it's also understanding these other areas. And then again, to increase that revenue, you need typically a vote of the public, to increase the sales tax or something like that, or to go for a bond. The budgeting, we all know that public entities have a long budgeting process, and in many cases, being on a school board, we often make budget decisions on incomplete data or because we rely on a funding from a higher authority. So in California, for a long time, for many, many years, we were required to approve our budget essentially before, by July 1 or June 30th, we had to approve the new budget, or June 15th actually. And yet the state of California didn't approve its budget, and so here we're having to approve a budget with not knowing what the final budget of the state is or how much money we're going to receive, and then would have to alter that, which then affects layoff notices and things like that. So from a budgeting standpoint, as a public entity, it can often be challenging, and as soon as you're done with one budget cycle, you might take 2 months off and you restart the whole next year's budget cycle process. And then financial reporting. There's typically extensive financial reporting requirements and standards, and that's also where you have the GASB standards as well become part of that. So again, these are areas you want to focus on there. And then as far as managerial accountability, these are some of the more minor ones. Contrasts and managerial accountability. Public officials are accountable to the general public and may have different priorities depending on, again, if they're elected. And then again, the challenge we have is frequent changes of public officials. At least for the private sector company, you're a little more stable. They have long-term plans of where they want to go typically as a private sector organization, at least large corporations do. And so you're not going to see changes as much as what we typically see, unfortunately, in a public entity. A lot of musical chairs. The political environment, again, every action is in the public domain. It's open to scrutiny. Public Information Act and Freedom of Information Act require accurate record keeping. The votes that we're taking, and of course just all that documentation to be able to do that, and that requires staff to maintain all the minutes and other type of public records. And then finally, citizens often focus on tangible results and focus on risk management needs is not interesting. So the idea that we're buying insurance or we're doing these risk control efforts doesn't really help them. They want to see that new pool bill. They want to see, that new program in place or things like that. And so talking about risk management and saying, here's what we need to do, is not necessarily going to get the votes. And from a budgetary standpoint, it just makes public entity risk management that much more difficult. In many ways, the Rodney Dangerfield of kind of public entity practice is, I would say in some cases risk management. And we don't necessarily get the respect, but in many cases we're saving our organizations, millions and tens of millions of dollars because of the efforts of risk managers. And then some of the when we talk about some of the distinctive exposures that we might have on there, we certainly have within the public sector. This is the last objective that we have in the chapter here. So we mentioned some of the property exposures to our facilities, the types of buildings, vehicle fleets, and when we talk about property, that could be swimming pools, anything like that that would be considered a property exposure. So that's some of the typical things of bus fleets, those type of things would certainly be part of it. We talk about employment-related exposures. What's interesting is we, from a city or university or any other really type of public entity, very types of jobs and skills with different risks. So we might have someone that does HVAC, plumbers, police, fire, and so we also have public entity or county-run hospitals. So you may have nurses, doctors. If it's a state agency, is a public sector, psychiatric hospitals. So all those things, when you really look at it, there's just so many different types of risks that are there. And again, the different trades, maintenance, daycare, faculty. You can have all, at least on the last one on trades, that's university. You can have all those different things there, at least on the faculty, and in some cases airports too might be part of it. Roads and streets. So this, it goes in more detail specifically, but roads and streets, potholes can certainly be part of that. But then also dangerous intersection or dangerous design claims can be made against the public entity. But maintaining roads and streets is certainly one of those. We look at Parks and Rec, and just I would say from Parks and Rec, think of it just parks or even daycare centers. I'd lump in that category. Fields, playground equipment, swimming pools, dog parks. In California, and I think in other states, it might be. I know California's required. But in California, every playground equipment before it's installed has to be inspected by a certified playground safety inspector. Now, I think for other states, it's not necessarily, it could be a requirement or it could be a best practice. I'm not sure, but I know that it's one of it's considered to be a best practice program in many other states. But again, it could be required. It's a good risk management program to have that as a backup to make sure the playgrounds are safe. Dog parks with that, equestrian centers might be Parks and Rec as well, lots of different areas. Law enforcement, I think everyone recognizes the risk with law enforcement. Special events, actually this is one, when I worked at Bickmore, and I worked on public entity, as a risk control manager for several pools. It wasn't my pool, but one of the questions always came up was about, can we have running the bulls? We typically get that question every couple of years, and lo and behold, Pleasanton decided to have a running of the bulls in their fairgrounds, so someone finally agreed to it, surprisingly. But if you're in a risk pool and you're in part of this pool, you may not, hopefully that's an exclusive event to where they own all the risk with any injuries associated. They have hopefully have tons of waivers to where no one, even someone that was injured, wouldn't necessarily be able to get that. But again, special events. For many areas that when we look at special events is also balloons, bounce houses. And I think we've seen pictures on the news in the last couple of years where bounce houses are flying up in the air, and we've known that those have always been a risk. And so some Parks and Rec districts or community service districts have actually banned the use of bounce houses, or they have to be an approved vendor, so people can't just bring their own bounce houses. Some exposures, utilities. Running for those that have electrical, or it's a special utility, so SMUD in California, Sacramento Municipal Utility District. From electrical at one point nuclear power plant. and Rancho Seco and some others, and then you have other types of wind generation or other areas, water, sewer. Obviously, those are unique type of operations. Social service aspect. Again, those could be in some cases daycare or other type of things. And then also some of the exposures that make it really unique is there's always going to be, unfortunately, changes in legislative and regulatory requirements. And one of the things that changed I guess not too long ago, is public entities must also comply with OSHA and other regulatory requirements. Up until, I believe, 2001 in California, public entities could be cited but not fined for violations of Cal OSHA. So after 2001, public entities could also be fined as well. So that was a change that basically gave a bigger stick to Cal OSHA to really encourage changes to risk control efforts in that area. Some of the other things that we typically, I mentioned before, unfunded mandates is part of that. And then also one of the challenges that is public entities is changes to workers' compensation laws. And again, I'll speak to those changes in California, at least I think what we call a 4850 claim in California. Someone can correct me if I'm wrong in that, but basically those that are police, there's certain types of, for police officers, to where if it's considered a claim in the line of duty, it's already considered accepted. And so one of the challenges there is that the person would also receive essentially their full pay up to a full year. So it's a little different than just a normal workers' comp claim. And I remember the word presumptive was really the key thing. And so certain types of cancers, as well as for fires as well. So workers' comp changes certainly affect public entities. So when they increase benefits, it also increases the cost of public entities as well when those type of things happen. So with that, that is all that we have to go through tonight. So again, apologize for the little snafu on the slide deck, but we'll make sure we do get that corrected. Everyone has the correct slides, and look forward to next week's class. If anyone has any questions, feel free. You can certainly go ahead and raise your hand, and I'll unmute your line, or you can go ahead and type in a question, and I'll answer that question that way. I'm going to keep it open for a little bit, but I'll stop the recording. And again, thanks for everyone for the class. There's still time if you have others interested in taking the course. Certainly encourage them. Go ahead and email them the link, and they won't be too far behind. So again, thanks everyone, and have a great evening.